Bravo. I mean, 26,000% return in less than a day of trading. I'm jealous. I'm super jealous. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of July 12th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. I bet you guys were crapping your pants on Thursday and Friday. I know I certainly was. The market seemed to drop off. The bottom dropped out Thursday into Friday, but magically, like nothing happened at all. By Friday close, we reached all-time highs again for the S&P 500. The NASDAQ, and the Dow. At one point, I think the Dow was down like 500 points this week. It was ridiculous. As usual, the Russell was the first one to drop and the last one to recover. Of the major indices, the Russell 2000 is still below where it was in the open of the week. But you know, what can you do? They're small caps. They'll respond eventually. It's growth. Wanted to give you guys a little news update from me personally. I'm working on restructuring my schedule so that come September or so, I should be able to put out a little more YouTube content than I am now. Get back to my Didi videos, that type of thing. Get back to my charting for potatoes series and do some of the other stuff that you guys have been requesting. It's just right now, this summer, my life is absolutely hectic. But no matter what, I'm still going to be trying to get these news videos out every single week. I still have not missed a single week since I started my channel back in November of 2020. Every week coming at you guys with these news videos. Let's get started with the news. Why did the stock market tank this week? A day after stocks touched record highs, it is the market getting drilled with some valid fears. And who doesn't love a good drilling? The Dow Jones Industrial Average tanked nearly 500 points in the early afternoon trading Thursday as investors showed concern that the plunge in the 10-year Treasury yield was signaling an economic growth slowdown later this year. Driving that potentially dreaded macroeconomic slowdown would be two factors. First, the Delta variant of COVID-19 that's sweeping across the world, and second, the Federal Reserve moving to taper its bond purchases before year end. Grammatical note, I hate when people do this and they do like ordinal first and then they do the number two. That just bothers me so much. Like first, second, not first two. 1, 2, first, second. Why am I even going off on this tangent? It bothers me as much as like seeing a list of terms, the number one, the letter B, the pound sign. I mean, what are you doing? First, second, 1, 2. Okay, whatever. Some of the analysts that they're talking to here are saying the market's about 4% overvalued right now. The upside potential between now and the end of 2021 is 0.4%. This is a pretty low number, and this is Hugh Johnson Advisors founder and chief investment officer Hugh Johnson. So if you want to believe Hugh Johnson here, we've got less than 0.5% of upside for the rest of the year. I don't really believe that. I'm pretty sure stonks only go up and we're still fine. Also, sidebar, sometime around when I publish this video on my YouTube channel, Richard Branson is going to be going up into space with Virgin Galactic. We should be seeing a really huge move from Virgin Galactic, assuming the flight is positive. The stock closed somewhere around the $49 level on Friday. The all-time high for Virgin Galactic is about 62. If this is a successful test flight, looking at the volatility moves in the stock, I would actually expect it to go above 62 this week. I don't know exactly where the top will be, and I'm not going to look foolish trying to guess it, but all things considered, this is probably going to be a big move for Virgin Galactic we're going to see on Monday. Now, God forbid everything goes sideways and somehow the rocket blows up, then Virgin Galactic likely goes bankrupt. That's what you're dealing with when you have a company that's literally flying people into space. High risk, high reward. Next news story, and probably the biggest news story for the week. China orders Didi app downloads suspended over data violation. Didi is like the Chinese version of Uber. You guys know how much I hate Uber on this channel. You also know how much I hate the lack of transparency with Chinese companies, so you can imagine how excited I was for the Chinese Uber Didi to begin trading. I wasn't. I was nonplussed. This didn't even approach my radar until this bullshit happened this week. China's cyberspace regulator said on Sunday it had ordered smartphone app stores to stop offering Didi Global Inc.'s app after finding the ride-hailing giant had illegally collected users' personal data. The CAC said Didi was told to make changes to comply with Chinese data protection rules 4 days after Didi began trading on the New York Stock Exchange, having raised $4.4 billion in an IPO. But the CAC CAC did not specify the nature of Didi's violation in a statement on its social media feed. So less than a week after Didi began trading IPOing on the NYSE, the Chinese cybersecurity agency said, yeah, no, stop that. Downloads of the app in the Chinese app stores were halted. Nobody new can sign up for an account. No new apps were downloaded. And this obviously created a bit of a problem in the market, and everybody's like, what the hell? This seems like a super shady cash grab from a Chinese company getting traded on the US market. First off, Didi was hoping to make way more money on its IPO than it initially got, and then shortly after it began trading, the stock price ended up tanking 20% off this news, and it had already dropped from its IPO price. The CAC on Friday announced an investigation into Didi to protect national security and public interest. We already saw what Chinese investigations into Alibaba meant. It meant Jack Ma disappearing, the stock price doing nothing for months on end, despite making huge amounts of money. The Chinese government, yet again, controls companies. On Wall Street Journal, things got a little more interesting. This was published hours after that Reuters article I just showed you. Weeks before Didi went public in the US, China's cybersecurity watchdog suggested the Chinese ride-hailing giant delay its initial public offering and urged it to conduct a thorough self-examination of its network security, according to people with knowledge of the matter. But for Didi, waiting would be problematic. In the absence of an outright order to halt the IPO, it went ahead. Oh boy, it gets worse. So apparently the Chinese cybersecurity agency told Didi not to go public because there were security issues with the app weeks ago, and the company still went forward with this just because they didn't get a firm no from Zinni the Pooh. Because of dissemination of news from China being shady at best, we actually don't really know what happened here yet. This could be the Chinese cybersecurity agency lying to save face and make it look like they didn't just rip off US investors of billions of dollars, or this could have actually just been Didi acting irresponsibly and listing despite the fact that they knew that they probably were going to get punished for doing so. Just because you weren't outright said no doesn't mean you shouldn't do something. This is like asking your girlfriend on a Friday night after you've been working overtime all week, baby, I want to go out drinking with the boys tonight. Is that okay? And she's like, I'm not going to tell you what to do. That's a no, guys. That's a no. Don't go. Abort. Red light. Red alert. Stop. Didi should have just taken a page out of every responsible boyfriend's book and known that this was a no-go. A lot of people were dogpiling on Jim Cramer this week. And to be clear, I typically dogpile on Jim Cramer myself. On Monday, June 28th, right before the Didi IPO, Cramer effectively said on Mad Money, get as many Didi shares as you can after the Chinese ride-hailing giant goes public. I want to add a little color to this. If you go back and watch the entire segment on Mad Money where Cramer was talking about this, he was saying that some of these smaller Chinese IPOs have been disastrous, like Luckin Coffee with the fraud, like RLX, like Phoenix Tree. These companies, these smaller companies that have IPO'd out of China, have fallen off very quickly. He argued that Didi is a market leader, has backers in Alibaba and some of the larger companies, and that it was a relatively safe play as far as Chinese companies go. So he was recommending, if you wanted to invest in a Chinese company, that investing in Didi wasn't a terrible idea. So I'm not trying to defend Cramer, but you have to understand the entire news segment where he was talking about that and not just take this one little sound clip out of context. Now, the reason people were dogpiling on him, just a few days later on July 6th, he was interviewed again and said investors should stay away from Didi. So what caused this 180? Well, obviously the government regulation. And in this interview, he goes on to say that the Chinese government doesn't really care about US investors, doesn't care about safeguarding their money. And if you look at the international trade situation, that makes a lot of sense. When you're investing in a Chinese company in the United States, you're actually investing in a shell company that mirrors the price action of the Chinese company. You don't actually buy shares of the company itself. That's one of the reasons that investing in Chinese companies is so dangerous, because you actually have no voting rights, you have no protection, and this kind of thing happens. And in this second interview, Cramer was saying that he's basically been heartbroken so many times now by Chinese companies, and he just wants to avoid them from here on out. If you've been watching my channel, you know that I kind of echoed this sentiment. I realize there are some good Chinese companies like Alibaba, like Baidu, like Tencent, like JD, but the majority of them are not really trustworthy. And out of all of those ones I just listed, truly the only ones that I would actually consider investing in are Alibaba and Baidu. Baidu because they have have international patents in AI, which is worth something, and Baba because they also deal with international e-commerce. So I feel like those two companies would be under more pressure to have a little bit more honesty and are less likely to go anywhere. That being said, this entire Didi situation has been a disaster. It's been a delight for me to watch because I didn't care about the company originally. I had this feeling of schadenfreude where I was just looking at everybody's misery, knowing that Didi was probably a crap investment because it's a ride-hailing service, because it's China, because whatever. But this just further reinforcement. Just avoid stuff out of China unless you're prepared to lose your money. If we take a look at the Didi chart, you can kind of see exactly what happened here. On IPO, we opened at $18. By the end of the day, we were down to $14. We traded around this $15.50 range for a couple days, and then right after the announcement was made, boom, 20% drop down to below 12. And since then, we've just been trading around this $12 level. This is a great example of how cautious people are about Chinese companies. This volume candle is almost the same size as the initial IPO volume candle, which means people were ready and waiting to get their money out if shit hit the fan. There's just not a lot of confidence from investors with Chinese companies right now, and this is actually looking very bad for the future of Chinese IPOs. Next news story, it's not really a news story, but it is just a quote that I wanted to read you guys. AMD CEO Lisa Su, who, by the way, is one of the greatest CEOs. Barron's recently named Su to its 2021 list of top CEOs. She was previously named to the list in 2019. Now, regarding the semiconductor shortage, the question was asked to her, do you have any update for our readers when you suspect the situation, being the shortage, will normalize a little bit? I think it's different for every subsegment of the market. For this year, it's going to continue to be quite tight. I think going into 2022, it will depend a little bit on the dynamics of the market overall, but we're certainly bringing on more capacity every quarter, so you'll see more output every quarter for sure. Also in this interview, she went on to talk about the acquisition of Xilinx and how it's going to set the company up for like 5 years to come with their adaptive and programmable chips, and she was super excited about that. She was very positive about the future of AMD, like you would expect with a CEO. AMD has been in a bit of an uptick in general since the middle of June, and in the middle of June, we closed out around $80, and right now we're at about $90, so this is a pretty significant increase. Also, I don't know if everybody's aware of it, but the analyst projections for AMD are pretty stellar. We've got the average at 104.79. We've got some analysts projecting 169.70, and then I don't know what these analysts are smoking down here, projecting $17 a share for AMD, but I'm pretty sure the world needs semiconductors. Next news story, Thoma Bravo to take Stamps.com private for $6 billion. Stamps.com said on Friday, private equity firm Thoma Bravo would take the e-commerce shipping solutions provider private for about $6 billion in cash. Stamps.com shareholders will receive $330 per share as per the agreement, representing a 67% premium to the company's close on Thursday, and the deal also includes a 40-day go shop period, which will allow the company to consider alternative offers, Stamps.com said. This is an incredible deal for Stamps.com. Shareholders are going to get paid out a 67% increase, which is going to factor in future growth of the company because the company's being taken private. It's not going to be traded publicly anymore. Thoma Bravo is one of the largest private equity firms that deals in software in the world. They have other things under their belt like SolarWinds, and McAfee. Oh boy. Actually, they kind of invest in some shitty companies, but still they make money hand over fist. So they're adding Stamps.com to this. For anybody who's not familiar, Stamps.com provides at-home shipping solutions. They're the only provider of US Postal Service authorized printable stamps. So people that run home businesses that ship from home, even small businesses, Stamps.com is an absolute lifesaver. It's a really, really great company. And a lot of people were thinking it was very undervalued as it was. If we look at the Stamps.com chart, you can see the volume candle here. This is the daily chart, keep in mind. And then the massive price upshot up to 324. The day before this was announced on Thursday, we closed at 197.72, and there really hasn't been a whole lot of vertical movement over the last couple months with Stamps.com. But then we ended up opening the next day at 322. We closed at 324. As we get closer to this 40-day cycle, obviously this price is going to creep up to 330, but but it's not going to go any higher than 330 because that's the buyout price. The most amazing part of this deal for stamps.com to me is right here. The deal also includes a 40-day go shop period. So the offer from Thoma Bravo is for $6 billion. Stamps.com has 40 days where they can still shop with other potential buyers, other interested parties, for anybody who wants to buy out the company for an even higher price, though I can't imagine anybody paying more than a 67% premium just to purchase stamps.com. So I think Thoma Bravo is going to win this one flat out, and this is kind of the end of the stamps.com saga. But there was something very interesting coming out of this. Twitter user Ma the Meatloaf 7 put out this technical analysis on July 9th. He mentioned that Stamp on the daily chart was indicating a lotto play. He said a close above 193.06 should set up 202 to 203 plus tomorrow. He advocated the 7, 9, 202.50 calls at a $47 midpoint price. You can see here the Bollinger Bands. We moved outside the Bollinger Band, so he was projecting a reversal on the trend, and he was right. I don't think he was obviously expecting the buyout by Thoma Bravo, but anybody who took this guy's TA at face value made out like a bandit on FDs, on 0 day to expiration, out of the money calls. This was the dumbest play, but it paid off handsomely. There was one Redditor, Kato63, who ended up buying 2 contracts for $90. You can see the value of his account and today's return. If you do the subtraction, you could figure out he spent $90 on the 2 contracts, which $45 a piece lined up approximately with the $47 recommendation from Ma the Meatloaf 7. And we had a return of 26,633% on a single day. So the person's account value ended up going from $90 to $24,060 in a single day. Personally, I think Kato63 is a madman, and obviously he was just playing this as a lotto play, but still there were people in the thread talking about how the SEC is going to investigate him for insider trading. But I mean, with the amount of money that he put in on Robinhood, on Webull, whatever platforms he put in, nobody's going to give a crap about him as long as he pays his taxes. I swore off FDs a couple weeks ago, but seeing stuff like this just, it kind of keeps it in the back of my mind. Now, I'm not going to do it. I'm not going to do it again. I'm not going to make the dumb mistake, but bravo. I mean, 26,000% return in less than a day of trading. Yeah, you can't beat that. You really can't beat that. It's a pure lottery ticket. Good job for these guys. I'm jealous. I'm super jealous. The other big news this week, the big stock price mover, was Newegg.com. Newegg was offering on-demand assembly of custom PCs, and the shares traded higher. So the shares traded higher on Wednesday after the company said its build-to-order service will offer professional PC assembly to customers who design computers on Newegg's PC Builder. The company shares were trading 87.8% higher at $51. Volume topped 29 million shares above the stock's 65-day average volume of just over 1 million shares. Wait, what? 87% higher on news that they were going to be doing custom built PCs? This was just a real head scratcher because this is good PR. This is solid PR. Newegg is an e-commerce platform that sells computer parts for the most part, electronics, that type of thing. Last I checked, it's somewhere around the 9th largest e-commerce platform in America. I used Newegg back before I left America. I liked it, but since then, Amazon has become more competitive for their pricing, and Amazon offers faster shipping, so I kind of stopped using Newegg. That's one reason why when Newegg IPO'd a couple months back, I didn't really pay attention to it. I think the competition has passed it and Newegg's time to shine is done. So why on earth did shares rise 87.8% off the back of this seemingly inconsequential news? Did a little research, brought me to Reddit. Reddit ended up linking me to an amendment number 7 to a Form F1 for Newegg. The part of this that was worth reading was about the reverse merger that Newegg just executed with Chinese Lian Luo Smart Limited and the 2 majority owners of Newegg. Now, the Redditor here ends up kind of summarizing this. I checked the numbers, it's correct from the form, and this is just a more visually pleasing format, so I'm going to read this for you here. So with Newegg, there are about 363 million shares outstanding, but the public float is less than 1% of this number. Wow. There are 2 Chinese guys who own most of the shares outstanding. Zhitao He, I know know I didn't pronounce that right. Sorry. And Fred Chung owning approximately 60.91% and 35.98% collectively, which is 96.9% of the company. That meant the float to the public was about 3.5 million shares. Oh, okay. There were only 3.5 million shares available, less than 1% of the float. So on this PR, any purchase ended up driving up the price substantially because there just weren't enough shares available to purchase and people wanted in on the company. And this caused almost an exponential rise in the share price of Newegg. Seems very fishy, seems very artificial, especially since Newegg can sell more shares at any time with a shelf offering. And at these elevated values, this almost seems like that's the intention of the guys that bought the company, to do a shelf offering for the company, and once share lockup ends, they're just going to sell off shares. So this is not something I'm even interested in purchasing or going near. As I said originally, I don't like Newegg, but at least this explains what happened. The price started ticking up here, and then we had the news about the PC building, and we ended up hitting a high of 79.07. Currently, we're already back down to 46.69, and frankly, I expect this to keep dropping. There's nothing fundamental supporting this valuation. One of the most heartbreaking things I saw when I was analyzing this entire situation was this article on Seeking Alpha. Newegg stock falls 30% as retail interest grows. With 1,113, Newegg had the most mentions of any stock in the daily Wall Street Bets discussion threads in the 24 hours preceding today's market open, according to Quiver Quantitative. That's up nearly 750% from the previous day. So here we go. Yet another example of why you should never invest on a hype train for a stock. I'm just imagining as soon as this started getting taken off on Reddit, and by the way, there was very little advanced warning that this could possibly happen, but as soon as things start taking off on Reddit, people end up getting burned, losing money on Wall Street Bets. In this case, stock drops 30% because, like I said, there's really nothing fundamental supporting this. So, moral of the story, stay away from Newegg. It's about to drop even further, and I mean, it was fun while it lasted. If you were in on it early enough within the first hour for some options before the volatility got factored in, then you probably made a killing. But past that, now the IV is too high to even buy puts. I'm staying away from this one. Let's take a look at the upcoming earnings for this week. We are kicking off earnings season. Gotta love it. The last couple earnings weeks have been terrible. They've been boring. I mean, snooze fest all around. As is tradition with the market, most of the financial companies lead off our first week. We've got JP Morgan Chase, Goldman Sachs, Wells Fargo, B of A, Citi, BlackRock, PNC, Morgan Stanley, Charles Schwab. There's others in here. You guys get the idea. A lot of financial companies. We have some others mixed in. We have a couple pot stock companies with Organigram, and Neptune used to be more of a pot stock company, but it's kind of getting away from that. It still is sort of affiliated, but I'll tell you guys what I mean in a minute. We've got Delta Airlines, Pepsi, so a couple of industry leaders there. Taiwan Semiconductors, that's going to be a great one to see. Of course, if you followed my video last week, I talked about an options play on Alcoa. And then we've got Ericsson as a 5G play. I love Ericsson. I am holding Ericsson, but it has the same issue as Nokia, where it's just got billions and billions of shares, and it's just going to be a slow mover. Now, full disclosure, I don't really have an options play of the week this week. I ended up investing heavily in the Alcoa calls last week, so I don't have any free cash available right now to do another options play. I mean, technically, yeah, I have my emergency fund, but I'm a disciplined investor, and I'm not going to dip into that, and I'm not going to do call options on margin or something crazy. So I'm just going to sit this week out. Last week, I did talk to you guys about the Alcoa play. Just a recap. Alcoa, I believe, is due for a really good earnings report, and there's some macroeconomic trends that could not have possibly been baked into the share price, with export tariffs on aluminum coming out of Russia and China. Those were unexpected when I talked about the option price. For the last week, Alcoa has effectively done nothing. It ended up dropping off in share price on the market drop Wednesday and Thursday, but it climbed back up on Friday, basically to where the price was at the start of the week. So my options are actually up like 1%, which is cool, I guess. But I mean, this was just the holding period. And after the earnings report is when I'm expecting to see movement on the price. The reason that the options are up about 1%, even though the share price is technically a few cents lower, is because the implied volatility is up almost 1.5%. When I talked about this stock last week, I believe the implied volatility was around 54.3% or somewhere thereabouts. We're almost at 56% right now. So remember, when you're dealing with options, even if the share price ticks down a couple cents and you have long call options. If the IV increases, then your options gain value. And this IV increase right here, getting closer into earnings, is why my options are up, even though the share price is slightly lower. And if we look at the 4-hour chart for Alcoa, you could see we ended up dropping off throughout the week and we recovered on Friday. After hours, we're up to 37.48. Still bullish on this option. Nothing's really changed except a couple days have elapsed and the IV is higher. Expecting some good stuff, but like I said, no options play for the week. But I do want to talk about some of the other companies that are reporting their earnings this week. Specifically, I want to take a look at Neptune Wellness Solutions. It's reporting on Thursday after close. Neptune Wellness Solutions is everything that I hate in a company. They focus on health, wellness, organic stuff, next-gen therapeutics like hot, organic food, just healthy living. Man, I'm a fat guy. I like pizza. I don't exercise. Ugh, this company is like the opposite of me. They value innovation, quality, sustainability, transparency, responsibility, partnership. That's nice. But they are a company that kind of collects their own brands. Now for cannabis, they have Mood Ring, which makes environmentally friendly cannabis-based products. They have Pan Hash, which is another environmentally friendly cannabis product company in Quebec. Organic food and beverages with Sprout, Nosh, and Nurture Me. Sprout is a huge acquisition for them. It's a very profitable baby food company, and this is going to be a driver of Neptune's financial future. They also have personal care and beauty with Forest Remedies and the Jane Goodall collection. You remember Jane Goodall, right? She's the chimp lady. She talked with chimps or lived with chimps or photographed chimps. I don't remember, but she's famous for monkeys. The cool thing about Neptune Wellness is it's a penny stock and options are enabled on it. The not cool thing about it is that the IV is astronomical right now. The historical IV is 45%. Right now it's sitting at 118%. So all options are expensive. And if we look at the Neptune chart, we are uptrending going into earnings. The RSI is getting a little bit high here. The MACD is trending upwards. But if we just take a look at the max chart, we are on a huge downtrend since 2019. Neptune Wellness had a really bad earnings report last time because the company is going through a transition where it was operating primarily as a low margin B2B supplier with cannabis extract. And now it's moving into a B2C type company that's acquiring brands to sell goods and products to consumers. That is an entire organization overall. To be clear, I think it's a net positive move for the company. I think it's a great move on their part, but it's going to take a little while for these changes to reflect in their sales. And the CEO even said on the last earnings report that this earnings report should indicate some type of stability, but they're not really expecting any big gains. So because of the high IV on this, I'm not really interested in playing any options, even though it's a penny stock. We'll see how it goes. I do think the company has a bright future. I'm going to put it on my watch list, but I'm probably not going to pay any attention to it until about October or November or so. The other company that I want to look at is Kura Sushi. Now, I've never actually eaten at a Kura Sushi restaurant, but I did read some reviews online, and everybody that's eaten there says it's pretty damn good. They're reporting on Tuesday after close. I went to FinViz just to get a quick idea of the metrics. Since October of 2020, the share price has more than tripled to where it is today, but these metrics look pretty bad. The price to sales ratio is 12.5, price to books 8.8, price to cash is 198. This isn't really great. The institutions are selling out of their positions, down 7.5% in the last 3 months. Margin, everything is decreasing. This looks pretty bad. It's short at about 7.5%, so that's not really relevant, but it is a low float company with only 3 million shares of float. If we take a look at the daily chart for Kura, we can see the increase here. We are in a general uptrend. We peaked at 43.78 back at the end of May. Since then, we've been dropping off. Once again, here's the incredibly low float of 3 million, but also worth noting, there's no options available on Kura, so don't even think about that one. I went back and I looked at the transcript of their last earnings report, and I was already a little hesitant because of the price to sales, price to book ratio of the company, the fact there's no options. I don't want to tie up capital buying common shares. And then this was the big turnoff for me. Keep in mind, this was their last quarter earnings report. As I mentioned briefly on the previous call, our fiscal second quarter results ending in February February were materially impacted by the increased severity of COVID restrictions. This was particularly the case in California, where 60% of our restaurants reside. Full stop, not interested anymore. California had some of the strictest COVID restrictions, lasting the longest of any state in America. This earnings report is going to have almost full COVID restrictions for the entire time in the state, with 60% of the restaurants' locations. Now, Kura did switch to an online model where they were doing some curbside pickup, some delivery type stuff, but in this earnings report, they went on to say that their sales fell drastically even despite these measures, and that these measures were not enough to stop the company from losing money. Also, just so you know, I'm not talking out of my butthole, here is when California finally reopened the state. As of June 15, 2021, the governor, Gavin Newsom, what a gem he is, terminated the executive orders that put into place the stay-home order and the blueprint for a safer economy, also phasing out the vast majority of executive actions put in place since March 2020 as a result of the pandemic response, leaving a subset of provisions that facilitate the ongoing recovery. Restrictions that ended on June 15th include physical distancing, capacity limits on businesses, and the county tier system. These first two, physical distancing and capacity limits on business, obviously affect the restaurant industry, and this just happened on June 15th. So this earnings report for the last quarter is going to include full restrictions on restaurants for almost the entire quarter, with just the exception of the last couple of weeks. There's no way that Kura reports a really great number. If they undershot their projections, then they could possibly beat their projections, but either way, quarter on quarter, year on year, it's not going to look great. That's it for me today. Like I said, no options play for the week because I did go in so hard in the paint on Alcoa. I hope you guys did enjoy the video today. Like I said, I'm going to be trying to rework my schedule to get more time to produce YouTube content, but that's likely not going to happen until August or September. So just bear with me. For now, it's just going to be the weekly videos and anything short that I can manage to throw together in the middle of the week. It is important to know that I am not willing to sacrifice quality for volume. And on this YouTube channel, I'm never going to be somebody who just spams out a bunch of reaction videos for the sake of getting a higher video count and a higher view total on my YouTube channel. That's just not the way I run. I want you guys to come here, see a video on my channel, and know that it's going to be quality content worth your time. As always, if you want to support the channel, please check out my Webull referral link below the video. If you use that referral link, sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Because I'm partnered with Webull, the free stock that I'll be getting is worth $30 or higher. As always, if you enjoyed the content today, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, stay safe. Good luck investing. I wish you green portfolios. See you next time.